When it comes to buying real estate, we're often told it's all about location, location, location. But in the stock market today, it was all about rotation, rotation, rotation. Mega caps were dumped in favor of everything else in what marked a pivotal day for market breadth. But what does this mean for the S&P 500? After all, the mega caps got us here. If they start to collapse, won't they take the market down with them? And if so, what are our key levels and downside price targets? In today's daily recap show, we're bringing you everything you need to know, from what to expect this earnings season, market valuation, and what happens when we get the all-important rate cuts. Today's inflation report all but assured the first cut in September, and we're going to talk about what it means for stocks and where you want to be positioned. The reality might surprise you, so buckle up, we've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and they came for the generals today. The big names, the big players, the market movers all got sold and everything else got bought. Guys, it was a crazy day of market rotation today. Nvidia down 4.7%, Microsoft 2%, Apple, Amazon. Tesla was down 8%, but what really bolstered Tesla's decline was that we're supposed to have Tesla's robotaxi day next month, I believe in August or the month after. That got moved to October or November sometime. The market just didn't like that, and Tesla was the worst performing stock of the mega caps. We also saw semiconductors as a whole get sold, some of the bigger names here in software, and some of the bigger healthcare names. Other than that, it was green across the board. It really was a mega cap rotation today. That's what we saw. Semiconductors, technology, communication services, discretionary were the worst performing sectors. You're literally looking at stuff like Nvidia, Apple, Microsoft, Google, Meta, Tesla, Amazon. They underperformed the SPY, and we were just rotating into everything else. Home builders, regional banks, rate sensitive stocks, commodity driven stocks, XME, GDX, XLRE. They were the top performers. Rate sensitive stocks, commodity sensitive stocks, utilities, materials, industrials, energy, financials, anything that was cyclical, tied to rates, tied to commodities, they outperformed today in what was a fantastic day for the IWM, up 3.59%, absolutely crazy. And before the open today, I actually came out and put out this post right here. I said small cap quality has been absolutely hammered this year. It really has, down 11.35%. This was Wednesday's close. But the melt up is imminent. I expect an explosive rally in all small factors, especially quality, driven by earnings growth, margin expansion, breadth improvement, and attractive valuation metrics. Something I didn't add there was also rate cuts, and we saw that with the CPI numbers. We're going to talk about that a little later. CAF, this ticker right here to 50, IWM to 235. The IWM currently trades at what, 210, 212, somewhere around there. A fantastic day here for small caps, but you know, the broader market too, the RSP up 1.22%. Bonds did gain because rates fell. The Dow Jones was pretty much flat on the day, a slight gain, and the two biggest losers, the S&P 500 down 0.88%, and actually not as bad as the Nasdaq, which was down 2.24%. Absolutely brutal action here in the mega caps. We saw large cap growth, large cap core take it on the chin, but large cap value was actually fairly positive here today. Mid caps performed really well, but the star outperformance was the Russell 2000, and it all stemmed from the CPI report. We got a very cool CPI report which pretty much emboldened the rate cut expectations here for September. Just a day ago, 70% probability of a 25 basis point cut, now sitting at 84%. The market is almost certainly expecting a rate cut here in September, and that's because of core CPI. Very interesting. The consensus expectation was for a 0.2% month-over-month figure. We got 0.1%, and this drastically changed the year-over-year figure. The expectation was for it to come in at 3.4%. It came in at 3.3%. And we actually look at headline CPI, monthly deflation. When you look at these numbers, right, 0.1% was the consensus, negative 0.1% was the actual print, and that put the inflation rate at 3%. The consensus was 3.1%. So very cool CPI print. Deflation in the headline figure, very interesting. And that saw the market saying, hey, we need these rate cuts now, because this Well, good in an inflationary environment can be very, very bad down the track. And that's why we saw the price action we did in the market. Rate sensitive stocks, home construction, regional banks, real estate were the best performers. And then because rate cuts are coming, easier monetary policy means commodities do really well. And that's why we saw stuff like metals, GDX, XLU, which is essentially like energy stocks, and XLE, as well as the material sector, all outperformed the S&P 500. Now, there was a lot going on under the hood in the market. The 10-year yield actually fell 1.73% today after that CPI print. And this was on the back of a weak 30-year bond auction, which saw very trepid buyer demand. We also saw falls in the 30-year bond, but we did see quite a bit of buying here from this week, still down on the day. Bonds gained as a result of the price action in yields, and TLT looking like it wants to go ahead and break that $94, $95 critical resistance, which would open up the key levels at 96, 97, 98. Value outperformed growth, and commodities looking very, very strong. Gold up 1.84%, very close to its all-time highs. If we actually go ahead and measure it, about 1.5% away from its all-time highs. Silver up 2.11%. And again, very close to its 2024 52-week highs right there. And this has been a great trade here for me. I bought silver at the $29 area and the position's up about 10%. Now let's talk about the S&P 500. So first things first, despite the price action we saw here in the S&P 500, still in overbought conditions, but then we dive over to the Nasdaq 100. Very, very interesting. We are no more overbought, still above the halfway zone, but that is an absolutely brutal candle here for the Nasdaq 100. I do think we're probably going to see some follow through. Maybe we get to like the 19,600, 19,200 level right here. That's probably where we'll find support in the Nasdaq 100. I think we're going to see a couple more days of rotation, or at least rotation into the weekend, where the mega caps are going to get sold off or trade flat for the rest of the week, while stuff like the RSP gain, and the RSP looking very, very solid. I mean, just yesterday we were saying this is probably the floor 162. We got to break above the 166 area, and that's going to open up these higher levels. I think we probably go for some all-time high levels. I think the first price target is obviously the 168 level here for the RSP, and then the next one above that is just going to be the all-time high 169. I think we can just flat out say the 170 level there for the RSP. Those are the upside targets. And then if we actually dive into market breadth, that's an all-time high for the advanced decline line for the RSP as well as the S&P 500. It's a very, very good action in the market here today. It's a very good action in the market here today. And it's actually kind of crazy to see how much pull these mega cap stocks have, because there were 396 gainers in the S&P 500, 107 losers, and the S&P 500 still finished down 0.88% for the day. Now the RSP up 1.21%, I get it, but still kind of crazy to see that type of market momentum and just the pull of those big names. Just goes to show that the market was really just driven by a few big stocks, and we're going to see what that's going to look like if the mega caps do continue to get sold for the broader market. But what we are seeing is healthy, even though the price action in the nominal return of the Nasdaq 100 and the S&P 500 don't look that great. Looking at the IWM, this is looking very, very strong. Is that a new 52-week high? Not quite, just below. But if we do see follow through in the IWM, and actually we are at the 211 post, so we are at a new 52-week high in the after hours here for the IWM. This is looking very, very strong. This type of gap up and rally reminds me of some of the price action we saw here in late 2023. You get these gap ups and rallies, you then consolidate, and then the next move higher, consolidate, next move higher, consolidate, next move higher. That's generally what the IWM probably will do back to its all-time highs if this is the rally that's going to take us to those highs. And there's a lot of room left to run in the IWM. 16% from where we are right now. It does look like this is a higher low. If we go ahead, break some of these highs, which we have in the after hours, we can then go attack some of the more key levels here in the IWM. Obviously, 212 being the first level, 227 being the next level, and then we can go for new all-time highs at 244. So let's go ahead, break above 212, consolidate here for the IWM, and then start the next move up to the 225, 226, 227 level. For the S&P 500, I think we just see some sideways action, right? I mean, in yesterday's video, we did go out and say that 5500 is the gamma flip, and that we would actually pull back after breaking the call gamma resistance. So we did see the bit of a pullback. We've actually broken below the 5600 area. I expect now the 5600 area, which is the call gamma resistance, to turn back into a strong resistance zone. And I think we can find support in the S&P 500 here at the 5500 level. From there, we can make the next move up. Once we get there, then we'll talk about what happens next. But for now, I think we see a strong support at the 5,500 area, and anywhere from like the 5,500 to 4,450, somewhere in here, that's where we'll find support. And then we can continue to move higher. Ultimately, what we want to see in equities is sort of like a pullback, a sharp pullback in these mega cap names, and then a rally in the RSP, the mega caps, mid caps, small caps. We want to see like a huge thrust higher in all of these names. If we can get that, that is what a healthy market rally looks like. And in yesterday's video, I said stuff like CAF and small cap qualities looking very attractive. I said this is probably a good place to buy. Despite what we're seeing right now, I still think this is a good place to buy. I think we're going back to all-time highs in stuff like the CAF index, which is here at the $50 level. That is my price target. I think the IWM, still good value. A lot of room left to run in that. Getting into the RSP, we're probably going to go attack 170 at the end of this year, probably 200 at the end of next year. So great place to buy right here, guys. Normally, when you see this type of price action, it doesn't just fall apart. We normally consolidate and then continue the move higher. So if you think you missed the rally, you haven't, get in now, have a dollar cost average strategy, buy the RSP right here, or if you see a pullback to the 166 level, the IWM, I mean, ideally you should already be in here at the 198 level, but if we break above the 211 level and hold, consolidate, we could see highs. So you want to buy above the 210, and the S&P 500, if we get to the 5,500 area, you want to be buys here. Market breadth looking great. This is actually what we want to see. We've been talking about this for a while. Let's just hope we get the follow through we've all been waiting for. So Q2 earnings season is here, and we have the first major player in the S&P 500 reporting. We have Pepsi. We're going to take a look at them, but just really quickly, tomorrow we have some of the bigger banks, JP Morgan, Wells Fargo, Citi reporting. Well, let's dive into Pepsi. Very mixed earnings here. This is recorded pre-market, by the way. Pepsi recorded an EPS beat, a revenue miss. However, you can see we actually down 2.15% here in the pre-market, and there wasn't much to love here with Pepsi's earnings. It was flat-ish volume, decent revenue growth. The problem is that despite flat volumes, a lot of the revenue growth and EPS growth came from price increases, and I just don't think that that's really that good for Pepsi brand. I don't think that staple companies have that type of pricing power. Management kind of gave a mild increase to guidance. They said 2024 guidance to 4% organic revenue growth, 8% core constant, but the market just didn't like the fact that volumes were still flat. At the end of the day, Pepsi can only do so much when it comes to operating leverage and price increases to increase earnings per share, and that's why revenue was down. Either way, not bad, not great, run-of-the-mill earnings. I think this is more of a Pepsi specific problem more than it is a consumer problem. Now, looking at sentiment, this right here is the AA sentiment survey. Guys, we saw a move up from 41.7 to 49.2 in bullish sentiment votes. This is extremely bullish sentiment if you compare it to the historical average. In fact, right here, we were extremely bullish, and we got ever more so bullish because we also saw a decrease in bearish sentiment votes. Very, very interesting. And it's quite obvious to see what happened. Those that were bearish flipped to the neutral zone, and those that were in the neutral zone flipped bullish. Because when you have these big names like Nvidia, Meta, Microsoft, Google, Amazon rallying, making new all-time highs, making headlines, sentiment gets ever more so bullish. But at the end of the day, these five names, which are essentially at all-time highs, running the market right now, are also growing earnings to back it up. I mean, look at second quarter expectations here for Nvidia through to Amazon. We term them the AI 5. 111% earnings growth for Nvidia, 19% for Meta, 15% for Microsoft, 13% for Google, 11% for Amazon. And at the same time, they also have the margins to back it up. In fact, growing margins on a quarter basis year over year, 10 basis points. That is kind of crazy. That's margins expanding. So we could see here the AI 5 growing earnings by 17% and then 23% net margins. This is why these companies absolutely rallying, and this is why earnings are remaining so robust in the S&P 500. And I showed you this chart yesterday. 2024 EPS is tracking a typical non-recessionary year. One thing I didn't show you is 2025. This light blue line right here is 2025, and we are actually seeing upward revisions in 2025 earnings. Now, we should see this trend kind of down to sideways into the end of the year. However, still very, very bullish price momentum, especially when you compare 2024, 2025 to both the historical average and the the average non-recessionary year. At the same time, margins are expected to expand in 2025, setting new highs, and we should actually see margins even higher than what we saw in the everything bubble in 2021. Now, with these big names, Nvidia, Microsoft, Amazon at the top, and market breadth looking very, very thin, there's been a lot of comparisons made to the tech bubble with the price action we're seeing right now. And yes, while there are similarities, it's not quite the same, particularly with valuation. This was the tech bubble in 2000. This is the everything bubble in 2020. This is where we are right now at about 34. This right here is the S&P 500 Shiller PE ratio. And while yes, it is high from a historical context compared to the peaks we saw in 2000 and 2020, it's not that high. And there is technically still gas left in the tank if we are to get a capitulation move to the upside. Do I think that's going to happen? Potentially. The thing with 2000 is that was just based on hopes and dreams. In fact, in 2021, a big part of this rally was actually based on earnings. The problem was a lot of those earnings was driven by the massive amounts of stimulus we pumped into the economy, and as a result, inflation reared its head and we had that cost of living crisis. And that's what caused the massive move down in equity markets. Let's assume we didn't get that inflation scare. I think markets probably would have stayed at about the Shiller PE ratio, traded sideways. Sure, we would have had a pullback, but it wouldn't have been as brutal as it was in 2022, particularly for tech stocks. I think we would have seen something more along the lines of maybe 10%, a very mild correction in price as well as time compared to the vicious correction we saw in 2022. But take this with a grain of salt. The thing with something like this though, the PE ratio, is that multiples give no direct insight to the magnitude of a firm's investment, whether they generate a sufficient return. This right here is, I believe, Peter Thiel talking on investment valuation. And he goes on to say, but there is more to this than insight, because the ability of multiples to capture the underlying economics of a business has degraded over time. This is mainly the result of a shift in how companies invest. In prior generations, businesses invested primarily in tangible assets, such as factories and machines. These investments were recorded on the balance sheet and expensed on the income statement through depreciation. Today, the majority of these investments are tangible assets, including customer acquisition costs and branding. But companies commonly expense these investments on the income statements as they occur them. Accountants record these investments as selling, general and administrative (SG&A) and research and development expense. This reduces current earnings. And essentially what's happening is that earnings in the year now are lower, and that's why P multiples are slightly higher. You really have to look at quality ratios, stuff like return on invested capital, return on equity. And when you look at earnings as a percentage of 3-year trailing capex and R&D, what companies did in the late 90s, early 2000s, and what hyperscalers are doing right now, the difference is super stark. Not only are they spending more in capex, their actual return on investment is significantly higher. So while the market may look a bit silly at this point, these big companies have the earnings to back it up, as well as the returns to back it up. And if you think things can't get any crazier, they certainly can. This right here is cumulative record highs or new all-time highs for the S&P 500, this black line right here, versus other similar years. This is just 23, 22, 21, 20, all the way back to 2016. And you can see that in 2021, 2017, the S&P 500 recorded 60 plus new all-time highs. So momentum brings momentum. And if we are on a similar trajectory to what we saw in 2021 or 2017, we can actually see higher highs in the S&P 500, and we could go as high as 58, 59, maybe even 6,000. And as the S&P 500 continues to make record highs, market breadth remains tangibly thin. And while breadth has improved in recent weeks, this bull market has been the narrowest on record. Almost 2 years in, less than half of S&P 500 stocks have rallied 30%, which is unprecedented. And what we really want to do is look for signs of a broadening, and we could definitely see that broadening in something like loan growth. As the Fed starts cutting rates, we need to watch for loan growth to take the baton from a deficit-fueled expansion. Real loan growth has been anemic in this bull market. As you can see right here, this reflects the bifurcated economy and to a certain extent, the narrow bull market. This is the real loan growth in the average bull market. You can see the discrepancy. Now, if the Fed can pull off a soft landing, history suggests that credit creation should ramp up as rate cuts begin. So we get rate cuts, credit creation starts, and that's going to fuel the loan growth we need to drive the broadening in the market. Then we'll see stuff like real estate stocks, home construction stocks, industrial stocks, energy stocks, bank stocks catch up to the gains that we've seen in stuff like tech. So long story short, expect rate cuts to bring the broadening out. But diving into the year now and looking at a barometer for the consumer, Costco reported their June sales results and they announced their quarterly cash dividend. Very interesting here for Costco investors. They're actually increasing their membership fees. Now, Costco reported net sales of $24.48 billion for the retail month of June. This was a 7.4% increase from the same period last year. These are the comparable sales growth as follows. These are excluding changes in gas prices and foreign exchange. So the consumer as a whole is still holding in there, but I'm not sure if this is a barometer for all of the consumer, because those that shop at Costco tend to be slightly more affluent than the average consumer. And consumption will remain robust as long as the jobs market, the labor market, remains robust. And we got initial jobless claims today. It came in at 222K. The forecast was 236. So we did miss, and we have actually been missing quite a bit here to the downside when it comes to jobless claims in recent weeks. You can also see that revisions have been to the wrong side of the spectrum. So we are starting to see an unwind in initial jobless claims that's not showing up in non-farms. And yes, we are getting revisions, but those revisions are still above the initial forecast. And while initial jobless claims can be somewhat of a leading indicator into non-farms is the print we really want to focus on, because that's what the unemployment rate is derived from. But in the year and now, the labor market looking a little bit weaker, a little bit softer than it has last month or at the start of the year. Now we're just going to dive into some charts to gauge overall sentiment and how we should be positioned as investors. Now this is utilities against the S&P 500, pretty much telling us should we be defensive or not. And as you can see, this chart is moving down. This pretty much means the S&P 500 is outperforming the utility sector. The utility sector is largely regarded as a defensive sector. And since this is moving from the top left to the bottom right, you don't really want to be in defensives. We did see mild outperformance at the start of 2024 when we did get that inflation or stagflation scare, but we have since abated from the highs. And while we haven't broken the lows we saw in 2024, we are in a clear downtrend since late May, early June. And since last year, August, we've been in a very, very clear downtrend with lower highs, lower lows. And this is telling us you don't want to be in defensive stocks. You actually want to be in growth stocks, risk on sectors. This is the technology against the S&P 500, pretty much the opposite to what we're seeing with the utility sector. You want to really be long technology stocks, growth stocks, risk on stocks. There's an appetite for risk. And yes, like utilities, we did see mild underperformance in the tech sector at the start of 2024. I would say it was actually more of just a breather after the very strong run we saw in tech stocks throughout 2023. And it has been one-way traffic since late April, early May, onward and upward. And this is actually a new all-time high in the spread between the XLK and the SPY. Or the sentiment is risk on, risk appetite is there, buy growth, it is the outperformer right now. And then looking at something like overall sentiment, this is bonds versus equities. And until this actually moves massively to the upside, you want to be invested in stocks, you want to hold equities. This is telling us that things are not falling apart just yet, and there's still a very big appetite for risk. So data in the week ahead. So today we obviously got the CPI data. Tomorrow we have another big print, the PPI. For those of you that don't know the difference, if you go to like a McDonald's, right? CPI is what you pay for the burger. PPI is what the business pays for the cost of producing that burger. Both is estimates. Month over month PPI 0.1%, ex-food and energy month over month 0.2%, and ex-food energy and trade, so super core, 0.2% as well. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.